My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found in some of the largest proprietary trading firms and hedge funds in the United States. 21 trading tips from Paul Tudor Jones. Paul is one of the greatest traders of all time. He's one of the greatest hedge fund managers of all time. He's one of the greatest macro traders of all time. When I was younger, I had a vision. I had a goal that I would spend a day with Paul Tudor Jones. I not only realized that goal in getting to spend a day with Paul, but I also became one of Paul's friends. Forbes has Paul with an estimated net worth of $8.1 billion, which would make him the 357th wealthiest man in the world. I believe his net worth is double to triple that. When you look at the Forbes 400, they're able to calculate this net worth by looking at the public stock holdings of people who own publicly traded companies. So for somebody like Warren Buffett or Bill Gates, it's much easier to know their true net worth because you just look at the number of shares they have and multiply that by the share price, and that gives you a number. When you're somebody who's private, somebody that doesn't have public funds, then those people, their net worth tends to be massively underestimated. I believe this is the case of Paul. Paul is somebody who has mastered the psychological side of trading. So these 21 trading tips have the potential to really change the way you think about your trading. When you're trading size, you have to get out when the market lets you out, not when you want to get out. Another way of saying is you get out when you can, not when you want to. This is something the average trader just doesn't understand. But the reality is that the market is not always liquid, and it depends on what you trade. Of course, something like S&P is liquid quite often. But there are pockets even in the S&P where the S&P is not as liquid. I had a lot of experience with this because I was a back month option market maker in soybean options, and I made markets and contracts that were 1-2 years out that were very illiquid. And when I would make a market in those contracts and I would trade with a customer on the other side of the order, I was the whole market. And so when I would trade with them, I might sit in that position literally for a month, 2 months, 3 months, and there'd never be another trade. So I'd have to be very smart in how I priced it because I couldn't just get out whenever I wanted to. And that's a bit of an extreme example, but for somebody like Paul who trades really big, he has to get out when he can. So we have an example I'm going to show you. In SPY, the swing high is 560.85. One of the things that we know when we see significant swing highs, we see significant swing lows, we know that traders, even myself, will often hide stops behind those points with the idea that if that's a strong swing high, the market will not go back there. So if the market is able to trade above 560.85, there's likely to be a lot of buy stops there. So one of the oldest tricks in the book, going back to the old trading floors, the locals in the trading pits, this was one of the common things that they would do, and they got replaced by really smart algorithms that are run by proprietary trading firms. And what they do is they hunt out these swing highs and swing lows where they believe that there will be a lot of stops hidden. And then what they do is if the market starts to trade up there, if it starts to trade up near 560.85, they're going to start buying everything. As it starts to get closer to 560.85, they're going to start buying all the contracts they can to push the price to 560.86. And as they do that, they're going to have resting orders above, waiting, or they're going to have algos waiting to read what's going on in the book. And so they'll bid it up. They'll kick off the stops. The market will go through 560.86 and all these buy stops will be triggered. Remember, most buy stops are somewhat of a form of a market order. So they just go get the order executed. You might have a stop limit, which puts a cap on it, but it still acts like a market order over a range. So the market will spurt when you take out these highs. So the market makers, the algos, will bid it into that level, already having orders working above. When they trip it, the buy stops come in and they bid it right into their offers and they make a quick profit. So Paul sees this, and so one of the tricks he uses is if he's long and he sees a significant swing high, he knows if those stops get triggered above the swing high, there's going to be a rush of liquidity up, and then he can sell into that. He'll have resting orders ready to sell into that to liquidate his position. And he'll be able to do it and no one will know what's going on. See, when you're a big trader like Paul, all these algos are watching for big traders. They're watching for big positions. And if they can sniff you out, if they can sense you have a big position on, then they're going to track you. And if you try and get out, they'll race you. So if you're long and now you want to sell, they're going to see you want to sell and they're going to sell ahead of you. Just like I mentioned with the stops, they're going to sell ahead of you, hoping then you're going to have to sell and you'll sell it to them lower. So it makes it very difficult. It makes it very difficult for you, if you have a big position on, to get out. But when these stops are triggered, nobody's thinking about Paul in that moment. They're only thinking about they got to get out of their position. So he's able to take advantage of this market condition to liquidate into it when nobody knows what he's doing. It's very, very smart. That's one of the key things he does. Here, where you can see the swing high right here, 560.85, and then you see later on this 560.85 level gets taken out. The market spurts, and then it falls right back down into the range. So Paul would be selling into that spurt, and he'd be out when, or he'd be reducing his position size when the market sets back. Never play macho with the market, and do not overtrade. Macho is another way of saying ego. Do not trade with ego. This is a big thing. So many people trade with ego. They want to prove how smart they are. They want to prove how willing they are to take risk. All these various things. Your job when you trade is to make money. That's it. If you have any other motivation besides making money, you should stop and go do something else. Now, as ironic and as simple as this sounds, that you just should be focused on making money, the reality is 95% of traders, they're not trying to make money. That's not their goal. They'll tell you it's their goal, but there's all these other games going on. Proving how smart I am, punishing myself for things that have happened to me in my earlier part of my life. Gambling and the feeling of the action. Is it going to work or is it not going to work? Okay, so we want to be very clear. We don't want to force our will upon the market. The market won't take it. And we don't want to overtrade. Overtrading is death to a trader. So we want to be really patient, see when the market's giving us an opportunity, and that's when we trade. If I have positions going on against me, I get out. And if they're going for me, I keep them. Again, this seems crazy simple. But do you know that most traders do not do this? 95% of traders do not do this. They might even say that they want to do this, but then when they get into their positions, they flip and act completely opposite. So when positions are going against them, now it's not about making money, it's about not being wrong. So if I can just get back to break even, if I can just have my position be a little bit of a winner, then I'll get out. So they sit in crappy positions, and sometimes they get worse and they get worse. This is such a common thing I see. Everybody focuses on their losers and how can they get out of them. They're taking the best of their mental faculties, the best of their mental capital, and they're devoting it fully to the most mediocre of ideas. Instead, what we should do is if things are not working, we get out. We take the best of our mental faculties and we put them into our best ideas. If we get a trade that's working for us, we keep it. As soon as everybody gets a position working for them, the first thing they start asking is, where can I get out? Where can I peel it? Where can I lock in a profit? You never go wrong taking a profit. Bullshit. That's how you never make it. So, if my positions are working, I keep them. One of my friends is a super wealthy, successful guy. Incredibly smart, and we'll be in these sessions where we're challenging each other, and we'll be talking about like what's going on with their businesses, and he'll just look at it, he'll look at me or the other couple guys in my group and he'll be like, stop doing that. Like we're struggling with something that's not making money. He's like, let's stop doing that. And then if we got something that's making money or doing well, he's like, well, just why don't you do more of that? Duh. Same premise here. I will keep cutting my position size down as I have losing trades. Rule number one that we talk to our students about all the time. Rule number one is come back tomorrow. Come back tomorrow, come back tomorrow. If you come back tomorrow, you will figure this game out. If you come back tomorrow, you will make it. But if you can't come back tomorrow, I promise you'll never get there. So that's what this is about. When my trades are not working, I cut my position size. This is something also that I work with my students on, and we have some rules that are incredibly helpful. If I have a position and it's losing money and I don't believe in it, or I think it's mediocre, I get the hell out now. I don't waste any more time on it. No more time. I don't worry about selling it higher. None of it. I just get out. Now, if I have a trade I really believe in and that trade is not working, that's different. So if I have a trade I have high conviction in and it's not working, then we start saying things like, okay, this trade's not working. And we have to define what not working is. It might be that you lost a certain amount of money. It might be that it's been losing money for 2-3 days a week, something like that. It's not just like it's down a little bit. That's not what we're talking about. We're talking about the trade is clearly not working in some way, either by time or drawdown. When my students have high conviction, but it's not working, then what we do is we say, okay, you're going to cut the position by 25% by the end of the day. You don't have to get out, but you get out at 25%. So if I have 20 contracts on and it's not working, I'll sell 5 by the end of the day. Now tomorrow I come in, I have 15. If it's not working, I got to get out another 25%, so I'll get out of 4. Now I have 11. Next day I come in, if it's not working, I got to get out of 25% again, so I'll get out of 3. Now I have 8. In 3 sessions, I've cut my position size from 20 down to 8. Cut it by 60%. I've never gotten fully out, but I've gotten smaller and smaller. This is massively helpful because this allows me to still be in the mental space that I can still be right, and my idea could still work. The other thing is then if it turns around and starts to work, we'll put it back on. We'll add to it. It's okay. But when it's not working, we systematically cut. This really helps. Last tip for today, do not average losers. This is something that Paul is adamant about. Now, what's interesting for me is I come from a hybrid. So what's interesting is you go out and you look at the market making community. What the market making community does is they average losers all the time. They buy and they buy lower and they buy lower. They sell and they sell higher and they sell higher. And this is somewhat of the function of the game. If I'm trading with a customer and this customer, I may not know how big they're trading. Let's just say I trade 100 contracts at a time and I'm a market maker and they ask me for a quote. So I give a quote to buy 100 or sell 100. And then they go, we'll sell you 100. And I find out like, they don't have 100 to sell. They have 1,000 or 5,000 or 10,000. Well, I'm then going to lower my bid and I'm going to keep lowering it as they keep selling with the idea that by the time they're done, I'm going to try and buy the biggest chunk at the lowest price. And this is how market makers work, and they make a lot of money doing this. So there's a flip side to this though, and that is once in a while that doesn't work. And so you'll see market makers, they'll make money consistently, really high win rate. They'll be the envy of everybody. They'll make money every day, every week, for days, weeks, months, years. But then, every 15 months, 18 months, 3 years, there comes along a position that they buy lower and buy lower, and it doesn't come back. And they get their asses kicked. And in some cases, they blow out. And I was deep, deep, deep in this game. I did it, but not at the level of some of the people that I was with because I legitimately was fearful of that scenario that I just mentioned. So Ray Conman is one of the greatest yield curve spreaders of all time. This is somebody who's made millions and millions and millions. And if you look at the great yield curve spreaders, these are people who trade 2-year notes versus 5-year notes versus 10-year notes versus 30-year bonds, different fixed income products. They spread them against another. So they can quote it as a spread, they can leg into it. Ray not only was one of the greatest of all time, but if you go through and look at the greatest spreaders in fixed income, a high percentage of them learned from Ray. Ray was very generous in sharing his information and creating literally a legion of great traders that traded fixed income. Well, Ray was a massive average down trader. I remember once hearing a talk that he gave, and he talked about that in certain situations when the spread was moving out of line and you bought it and you bought it and you bought it and it was not working, his answer was you just keep going. And literally he's like, somebody said, what if you run out of money? He's like, well, then you make sure you have a home equity line on your house and you go tap the home equity line and you put more on. That worked well for Ray. I could never do that. And for somebody like you, it could be a death trap, absolute death trap. So again, we want to put our focus into our best ideas. So when we're averaging losers, we're putting more and more capital and more focus into the worst of ideas. So I do believe I can buy and buy lower. I think that's okay, but there's a limit. There's a limit to how much I will buy and buy lower. Like I'll buy lower once. There's a limit to the size I'll do. So I won't do full size, but I will do it because in some cases it's obvious the trade's still good, it's still setting up, and I can actually get in a lower basis. One of the reasons this is so attractive is if I can buy and buy lower, my average cost goes down, and in some of those cases my R can explode. Or if the market does turn around, I can have a massive R. But the key word there is if it turns around. And you can get massive R trades without doing that. So if you're just new to trading, don't average losers. Don't even go there. Paul doesn't do it, and he's one of the greatest ever. Like I said, I'm a hybrid. I've come from both. I do some of both. But one last thing on this. One thing that I teach people who do average down, and this is what I've done, and as I've trained traders, this is where we use option markets all the time. And one of the things I'm able to do, I have one of my students who I trained. He's probably the best natural gas trader in the country, maybe the world. He's a massive spreader, kind of like a Ray Conman. But one of the things that he does is he's always out buying thousands of teeny calls and puts. And the reason he does those is that if he gets in one of these situations where he buys and buys lower or sells and sells higher, and it starts to get away from him, well, that means the market's really launching, and then he'll have thousands of calls that cover him. And these calls can explode, and they basically are insurance for him that he'll never blow out. What's been phenomenal for him is that he gets to be the liquidity provider of last resort. You want to make a lot of money? Be the one person in the world, or the one person of three in the world that can help somebody come out of a massive position that they're getting killed on. This is where they call it buying the book, where you can buy the book from a trader. So a trader may have a book that they're hemorrhaging millions of dollars and they just want out. You can come and buy the whole book. Well, he's one of the few people in the world, if somebody's in trouble in natural gas, they call him and they'll say, will you buy our book? And he can do it because he owns thousands of teeny options. So he is in some respects averaging, but he has his ass covered by all the options that he uses. This is something I taught him. This is something several of my other traders did. And so this bailed us out so many times. When our competitors were getting killed, we were still in the game. So, but that's very advanced. For you, don't average losers. So, what day is it? That's right, it's Tuesday. And it's not just any Tuesday, it is Trader Tip Tuesday, where today we learned 5 of the 21 trading tips from Paul Tudor Jones. These tips help you take your performance to an elite level. I'll do it again next week for you. Come back and see tips 6 through 10. I'll see you next Tuesday.